Hey everybody, welcome to Super Stock Bros. If you're new here, welcome. If you're not, welcome back. My name is Ace, and today I'm going to be talking to you about investment risk and why losing your early savings should be avoided at all costs. There's a common saying in tournament poker, and it goes, any chips won are worth less than the chips that you lose. Now, what does that mean? That means that if you're losing money, those early chips or your early investment funds are actually worth more than what you're trying to win. Okay? So taking that risk that you're thinking about taking is probably not as good as an idea as you think. And I'm going to show you why. I want to show you a simple example of what happens when you take big risks. While it's true that you can win, many more times you will actually lose. And when you lose, it's absolutely devastating. So let me show you an example of consistent investing versus the gambling investor. I'm going to assume that there's only one deposit of $10,000. And I'm going to also assume that you can make 15% compounded every year, which is not totally unreasonable. And actually, in another video, I'll show you how you can make about 5% a month if you do things properly. Now, the steady investor will continually make those 15% gains and compound it, without taking out any money. And a couple of examples of how you can do this is by, selling covered calls or earning dividends and reinvesting. Now, let's just assume nothing crazy happens and the market goes up because guess what?
Stocks only go up.
Now, that's been particularly true of the market, within the last few years. It's been a crazy bull market and nothing's guaranteed, but let's just assume it is. Okay. Now, let's take a look at the riskier investor. Like you're seeing this with the normal investor that's, slow and steady, and you can actually see how they're increasing, and I'll talk about these graphs a little later on. But for the riskier investor, I'm going to go to this gambler's nightmare sheet. They have the same thing, except, on the second year, let's say they see some hype stocks and or discover call options, and they decide, hey, let's try out this call options thing because I want to get rich quick. Now. So this is going to be interesting. I'll show you what happens here because we're going to see what happens if you lose 90%. I think this has happened to a lot of people. It actually happened to me. And, it's still going to take a little while to recover. And you'll see how long it's going to take to recover for this particular gambler. Okay. And I'm saying gambler because they took a high risk investment trying to win big and they ended up getting crushed. So I'm going to call them a gambler. Now let's take a look. Let's dive a little deeper here. So they lost 90% of their investment, kind of sucked. Now they're back to $1,000. What happens? How long does it take to get back to your original investment? So, okay, you're compounding 15% a year. You learned your lesson. And now, let's see, you're gaining every single year. And it takes about 13 or 17 years to get back to your initial investment. Okay. So right now, let's picture them starting off at 30 years old. Right now, they're a 50-year-old recovering gambler. Okay, so they got up to 11.5 and then dropped down to 1,000. And now they're finally back at their initial investment. That took 17 years. Okay, that's crazy. Okay, so they're 50 years old and they finally just got back to their initial investment. Okay, now let's see where the consistent investor is at 50 years old. You might be surprised by this. So remember, this is just basically it's a 1x gain. They just got back to their original money. So the consistent investor is now at $142,000. Okay. They're at 14 times their investment. The gambler is at only 1x their investment. What an insane difference. Okay. Let's see how long it takes with the consistent investing to get to $1 million along this line. It's only a few years later. And they finally hit at 64 years old because they started off at 30. 30 is the new 20. They hit $1 million. Okay, it's a nice steady graph, increasing slowly but surely. They didn't take many risks, and you know what? After 34 years of investing, 10,000 turned into $1 million. Okay, very nice. So, where do you think the gambler is going to be when they get to 64 years old? Okay, let's take a look. You might be surprised by this one. At 64 years old, the gambler is only at, around $80,000. So the that's crazy, right? The original investor is at 100 times their investment, and the gambler is only at 8 times their investment. This is the power of compounding, and also why you shouldn't take that many risks, or at least reduce your risk to a point where it's manageable. Now let's continue with this example. Okay, so let's say the gambler keeps going. How long will it take the gambler to get to $1 million? Well, they'll be at 83 years old by the time they get to $1 million. Okay, it's they a little bit more than $1 million, but they finally get there at 83 years old. Okay, wow, it took forever. That took such a long time compared to the other steady investor. Remember, they made it at 64. Okay, so let's look back at the steady investor. Where are they now at 83 years old? Well, guess what? They're at around $14 million, right? $14.3 million. They're basically a yacht captain. Okay, that is such a huge difference. This is why taking risks early and losing your initial investment you should be very, very careful with it. In fact, this is why you hear all of the billionaires talk about risk and being risk averse and being careful and patient because of exactly this example. All right. Now, okay, I'll note I said that you only get one deposit. So if you have a ton of cash flow, then maybe you can get away with some gambling here and there. But for the average investor, it's a terrible idea. In fact, for more reasons than one, because for the average investor, you might actually just never invest again. You might put money into the stock market or options trading. You lose the money and then you just never go back. Well, I just showed you can turn 10K into $1 million pretty quickly if you're a steady investor, right? So I'm going to show a quick video with Ray Dalio. Now, Ray Dalio is a billionaire hedge fund manager. He is the founder of Bridgewater Associates. And he talks about in this video his holy grail. So he talks about, correlations between multiple income streams and what it means to your risk if you have very little correlations between those income streams. Now, when you're managing billions of dollars, you want to reduce risk of loss because at that point, gaining, it means something. But really what you're trying to do is you're trying to make small, consistent percentages so that your investors stay happy and you're beating inflation. And at the same time, your money is safe and you're not losing that much, if anything. In fact, you're going to be gaining something. So risk is the name of the game. And honestly, it should be the name of the game for even small investment amounts as well. And that's what really this video is all about. So let's go ahead and watch this holy grail breakdown by the legendary Ray Dalio himself.
The real question for me was, what were the marginal benefits of diversification like? What is that going to look like? Okay. And what I then decided to do was to think about risk and the number of sample size and the correlation of the bets, broke it down to each of its components, right? So to use an example, let's assume you have, to make it simple, a return, something that has a 10% risk. We'll call risk standard deviation. And let's make it simple, and let's say it had a 10% return. And let's say I add in another asset, another return asset, return stream. I add in a second, a third, a fourth, a fifth, up to whatever number. How would that reduce my risk if it on average has a 60% correlation? Or if it has, on average, has a 40% correlation, or a 0% correlation? How would that change? Wanted to know that, right? So that's what this chart shows, right? And so, so imagine you have a 10% average return. You don't know which bet is going to be better. Has a 10% average return and a 10% risk. And you add in a second and a third and so on. You're not going to lose the 10% because you're still going to have that 10% return, but you're going to then have a reduction, and that's the reduction in risk. And if it has a 60% correlation and you have 3 or 4, you will get a reduction that maybe it's about 15%, and you could add in 1,000 if they're 60% correlated, and you're not going to reduce your risk much. Okay, that's important. Now, if I look at that, how that changes according to the levels of the correlation, I start to think, well, what would happen if I added in something that had a 10% correlation, by way of example? Okay, now that's what that line shows, okay? And it shows how much, okay, at about 7 or 8 or so, I cut my risk in half. That means I've doubled my return relative to my risk, right? Ooh, that's good. So as I go...
So that's actually a key point there. I don't know if you caught that, but basically now he's determining return based on risk. So this is actually how the big players think. Really, they're trying to create a ratio between risk and profits, whereas most amateur investors just think about the profits, right? But really, you want to hit that golden ratio where you're reducing as much risk as you can and making them as much profits as you can. So again, big money players, but let's continue.
Down this, I then start to understand what the power of diversification is in terms of the things that I'm going to look for. So what that taught me is the magic is you only need to do this simple thing. The simple thing is to find 15 or 20 good, uncorrelated return streams. Things that are probably going to make money, but you don't know, but they have a good probability of making money, and that are uncorrelated, that have low correlation. That told me that's what I have to go after, right? That's the key. A lot of people think that the most important thing you could do is find the best investments. Okay? That's important, okay? But there is no great one best investment that can compete with something like this. So look at this line. When this comes down, you can improve your return to risk ratio by a factor of 5, right? 5 times the expected return for that unit of risk. You can't pick any investments that are probably, nobody's humanly capable in an efficient market probably to pick investments that are 5 times as good individually, but so that path. So it tells me about the power of diversification and balancing risk. So this is the return to risk ratio that happens for each one of those. Like if I can get 0 correlation and I have 15 to 20, I'll have an information ratio, a return to risk ratio of 1.25. That means my probability of losing money in a year is only 11%, okay? As distinct from 40% with any one of us. So that's the power of portfolio construction and the power of diversification, okay? So it tells me what I have to go after.
Yep, that's big. So, to sum up basically what he's saying there, it's, yeah, you're trying to go for profits, but you should also think about your risk, because guess what? Losing that money is way more detrimental than making that money. And when you get further and further into this investment game, you do realize that risk is one of the more important things, if not the most important thing, to protect your portfolio and make sure that it gains consistently. All right, reduce your risk, because this is what the rich people do. This is how they always think about investments, basically. And if you want to be a rich person, you have to think like a rich person. So that's all I had for today, Stock Bros. Be careful with your money. Be careful with the investments out there. And let's make those gains.